Mhm. All right, perfect. I'm going to go ahead and get started. So my name is Deanna LaRue, and I'm a certified financial planner in Woodstock, Georgia. And recently we had this same event live in our office, and we had a lot of requests to do a virtual version for the people who wanted to come and weren't able to make it. So I'm very excited to be able to share this education with even more people today. To be respectful of everyone's time, this webinar will last about 40 minutes or so. And as you think of questions, just throw them in the chat. And if we have time to answer at the end, then we'll do that. Otherwise, we'll definitely respond to you via email. So let's start with why we felt this is a good topic for the current environment that we've found ourselves in. As a CFP, Certified Financial Planner, I want to always be educating my clients on opportunities in all areas of finance. Even if I know just enough to make me dangerous, and then kind of pass it on to the experts like our guest speaker today. And I know that all of the other professionals that have joined today want to be able to do the same for their clients as well. You know, no one loves to pay taxes. So we are all looking for ways to, not necessarily cheat the system, but to understand the rules and to take advantage of those rules when we can and save on those taxes. So a 1031 exchange is a way to sell a property that has large capital gains and either defer those gains by immediately purchasing another like-kind property, or using an investment vehicle like the one that our speaker is going to teach us about today. And on that note, I'd like to introduce our speaker, Joe Kingsley. Joe is Vice President of Inland Securities, and he's responsible for working with financial advisors like myself and our clients and other professionals like accountants, realtors, and attorneys within the Southeast region. Joe has been working with real estate securities for over 20 years, so he brings just such a great wealth of knowledge in this really confusing area. And he had joined Inland in December of 2019 and worked at Black Creek Capital and American Homes for Rent prior to being with Inland. Joe graduated with a degree in economics from the University of Arizona in 1990. So, Joe, I just want to say thank you so much for sharing your precious time with us today, and I'll just kind of turn it over from here.
Well, thanks, Deanna. I definitely appreciate you allowing me to participate with you in your client webinar here today. So, as Deanna mentioned, if there are questions, please feel free to type them in using the chat feature, and then we'll address those questions if we have time at the end. And I'm right here in Atlanta too, so I live in Brookhaven. Been here for 20 years, moved up to Georgia from Orlando. I went to the University of Arizona, as Deanna mentioned, in Tucson. My football team has probably never beaten any of your football teams. So unfortunately, we've lost 13 games in a row. We did get a new coach this year, but chances are we probably never beat your team. But for those Georgia fans on the call here, congratulations on the big win over Clemson this weekend. So with that, we'll go ahead and get started. So what we're going to cover today is 1031 exchanges and the tax advantages associated with the program, and how you can utilize a 1031 exchange to kind of defer a large capital gain tax bill, and in some cases completely eliminate a large capital gain tax bill. So my company, Inland, we've been around for over 50 years. We were founded back in 1968 by 4 partners. They're still the same 4 partners today, actually. So a lot older than they were back in 1968, but still the same 4 partners today. And we've done about 25 billion in real estate programs for individual investors in the United States. In 1990, we started doing 1031 exchanges, and today we're the leading company in the country that offers replacement properties for investors looking to do a 1031 exchange. In 2001, we actually had a separate division within Inland to do 1031 exchanges. So since then, we've offered over 6 billion in properties to investors and purchase those on behalf of investors. If you look at the map here, we've invested in 43 out of the 50 states. So everything that's not a gray shaded area, we've owned and managed properties in. And now we're getting close to 800 properties that we've purchased on behalf of investors. So when we first started as a company, we started out doing apartment complexes in and around the Chicago area. That's where the founders were from, Chicago. So they started buying apartment complexes. Then they started doing retail grocery stores. And then they became the largest owner of Walmart stores in the country, the real estate that Walmart leases. We own the property. So we did that in the 70s and 80s. And today, the programs that we're offering are in a few different sectors. So multifamily apartment complexes, industrial warehouses leased to companies like Amazon, FedEx, UPS, also self-storage facilities. We're on our 14th program in the self-storage category as well. So with the tax code itself, this has actually been around for 100 years. So the 1031 tax code was written back in 1921 and written into law by the IRS. So really what it's designed to do is for people that own real estate and would like to sell it, they can sell their real estate and invest in additional real estate and defer all the taxes. So that tax code is really designed as a large tax deferral tool. This is just for real estate sales, so wouldn't apply to gains from other investments like stocks or bonds, just real estate to real estate. And when the IRS wrote this tax code back in 1921, we were in a recession. So the US economy was in a recession, and the IRS wanted to encourage people that own real estate, if they were selling, not to just take the money and stick it under their mattress, but to take that and invest it in additional real estate and keep that in the economy. So when they wrote the definition of the tax code, they said you could sell virtually any property other than your primary residence. So anything except the house you're living in, and then you could turn around and exchange that into any type of commercial real estate. And they wrote a definition called like kind, and any kind of commercial real estate is like kind. So someone could sell raw land, and there's a question from David that we'll address at the end. Someone could sell raw land, let's say, that's purchased by a developer or an individual, and take the proceeds and buy into a multifamily apartment complex or a big distribution center leased to FedEx or Amazon. So every type of real estate other than your primary residence is really eligible for 1031 exchanges. So a few rules to follow. The property that you purchase has to be equal or greater to the value of the property that you sold. Any cash that you receive from a sale needs to be reinvested in the property that you're purchasing. And then if you had a mortgage on your property, what happens is when you sell your property, the bank gets paid off the balance of the mortgage. And then what you need to do is invest in a property that has the same percentage debt or the same percentage mortgaging as the property that you sold. Don't get too hung up on that one, because we'll do the calculation for you. If you just let Deanna and I know how much you had left on the mortgage when you sell the property, then we can tell you how much you need to replace. And our programs already have the loans in place. So we can tell you which programs would be appropriate for you to replace the debt. Now, if you take any cash out of the deal or you don't replace the debt, then you do pay taxes on that part. So as long as you replace all the cash, and if there is a mortgage, replace the value of the mortgage, then the whole transaction is tax deferred. So no taxes due then at the time of sale of your property. There's a timeline to keep in mind. So even before day one, let's say you know you're going to sell your property and you're 2 weeks or 3 weeks out from closing. At that point in time, you want to engage a qualified intermediary firm. And a qualified intermediary firm is really an escrow agent company. What happens is at closing, when you sell your property, the money needs to go to a qualified intermediary, and they just hold on to that until you tell them what to do with it. If you don't have a qualified intermediary lined up and you sell your property and take the proceeds and put it in your checking account, then you cannot do a 1031. So that's really the most important step right here. Line up a qualified intermediary. And Deanna and I can refer you to intermediaries right here in town that have been doing this for 30, 40 years. Then the day you sell your property, the clock starts ticking, and you have 45 days to identify potential replacement properties that you'd want to invest in. And then by the 180th day, you need to purchase some or all of these replacement properties that you identified. So it has to be listed here within the 45th day for it to be an option. And then by the 180th day, you can choose to buy some or all of those properties you identified, but it does need to be on the list for you to have it as an option. Again, the qualified intermediary comes in and accepts the money at closing and holds on to it until you tell them what to do with it. This does have to be an independent firm, so it can't be the current realtor or attorney or accountant or financial advisor that's working with the client selling the property. And we can refer you to qualified intermediaries, again, right here in town. So in our programs, generally what we're doing is we're purchasing the property on behalf of the investors. Investors take their proceeds from their sale, invest in a portion of one of our properties, and then they receive income from the rent that we're collecting from the tenants. So income ranges anywhere from about 3.5% to 5% paid monthly. That's an annualized rate paid monthly. It is highly tax advantaged, so you don't pay taxes generally on about 70% of that income. And then we tend to own the properties for approximately 5 to 8 years. And then we'll look to sell those properties at that 5 to 8 year mark. Our average return for our previous programs that we've sold, and we've sold over 2 billion of the 6 billion that we purchased, the average return has been between 8 and 10% annualized. So usually about half of that's from income, and then the other half is from capital appreciation at the end of the day. And one very important tax feature of the 1031 exchange is if somebody passes away when they own a property that's in a 1031 exchange, the heirs receive a step up in basis. So your original tax liability from the property that you sold is washed away when the heirs receive it, because they do receive a step up in basis. So from an estate planning perspective, heirs do not owe any taxes on property that they received in inheritance, and that includes 1031 properties. So never have to go back and pay taxes on the old capital gain from the first property that you sold. Also, these programs are eligible for what's called a 1033 exchange. This would be proceeds received from an insurance company, let's say for a tornado or a flood or fire or something like that. Thankfully, we don't have hurricanes too much, at least up through Atlanta. But if you do have clients that receive proceeds from a settlement, you can use our programs for those proceeds and defer all the taxes also. So our structure in our deals is a Delaware statutory trust structure. So Delaware statutory trust, we're allowed to start accepting 1031 exchange proceeds in 2004. And we actually worked with the IRS to write the tax code. So Inland, we were pretty integral in working with the IRS to get this approved. And it's a much more efficient structure than previous options. Prior to 2004, if someone wanted to do a 1031 exchange, they either had to find their own property or they can invest in a tenant in common structure. Those are also known as TIC investments. And in a TIC investment, that was limited to 35 investors. You could only own one property in a tenant in common structure, and everyone had to vote if there was any decisions to be made. So let's say 34 people wanted to sell the property and one didn't, you couldn't sell the property because all 35 people had to unanimously agree, just like a jury. So pretty inefficient structure. In a DST, we can have 2,000 investors. The DST can own more than one property too. So some of our programs have owned up to 15 properties in one DST. Nobody has to vote on anything, very important. So the manager makes the decision on behalf of the investors, and nobody has to vote on anything. And one other very important point is there's no liability for the investor at the property level in a DST. So if let's say somebody slips around a pool of an apartment complex, your investors that own that building through a DST structure can't get sued in any way. So you're never liable for anything more than your initial capital contribution. And then DSTs will also never go back and ask for more money from clients. So we raise a set amount of capital. A DST already has the property purchased that your investors can then choose to invest in. So Inland actually goes out and buys the property on their balance sheet, puts it in the DST structure, and then clients can invest in that, and they know exactly what they're getting down to the address of the property, the lease terms, if there is a loan associated with that, what the terms are on the mortgage. And we're very transparent at the property level in each DST. So much more efficient structure today than it used to be prior to 2004. So again, the timing of a deal, the first thing that needs to happen is a client needs to decide they're going to sell their property. And then before they sell, you want to line up the qualified intermediary account. And then at closing, the money goes to the qualified intermediary. And then the client tells the qualified intermediary where they want to invest the money. And the qualified intermediary sends the money then to someone like us. And then the exchanger, the purchaser, receives a closing statement that shows their percentage ownership in the DST itself. So let's take a look at the tax advantages. This is really the most important topic, I think, within the presentation, how much you can save in taxes really by doing a 1031 exchange. So let's say a client is selling a property for $1 million They don't have a mortgage anymore, so it's been paid off. And they originally paid $100,000 for the property. So maybe they've owned this for a while, paid $100,000 for it. Now they're selling it for $1 million. Over time, they've depreciated the value of the property down to zero. So on their taxes, they've depreciated the value down to zero. When they sell the property, tax bills are due if they don't do a 1031. So the first tax bill due is depreciation recapture of that $100,000. That's taxed at a 25% tax rate. So that's $25,000 due. Federal taxes are due at 20%. So that's the big one. That's $200,000 due to the IRS. We're using 5.1% as a state tax example. Most states in the Southeast are 5 to 7 in state taxes. Florida and Tennessee don't have a state tax, but we're using 5.1. So there's another 51,000. And then Medicare tax, another tax, sort of a hidden tax, kicks in at a sale of that level. So that's another 38,000. So this investor is writing checks for $314,000 in taxes. So he's losing about a third of his investment value to tax bills. If this same investor does a 1031 exchange, you don't have to pay depreciation or capture tax, no federal tax, no state tax, no Medicare taxes. So that investor's got his full $1 million to go invest in another property. And again, our programs tend to pay anywhere from 3.5% to 5% in monthly income. So this investor can get up to $50,000 a year in monthly income. And it is highly tax advantaged. Generally, you pay taxes on about 30% of the income, and 70% is tax sheltered by depreciation. And he's also got that full $1 million working for him, purchasing another property. So let's say that $1 million turns into $2 million. Well, that investor can keep doing 1031 exchanges and keep deferring the tax bill. And then ultimately, at the end of the day, if the investor passes away, the heirs do receive a step up in basis and don't owe taxes on all the old capital gains from the previous properties. So very powerful tax saving tool. The income that's produced is categorized as passive income, and the depreciation pass through is known as a passive loss. And if you do have any old passive losses from other investments that you've owned, that it could include depreciation that you've had on properties that you haven't offset with income, or just losses from another passive investment. If you have those never expire, and you can offset passive income from a source like a DST with those old passive losses. And if you do that, you're getting that income tax-free, as long as you're matching it up kind of 1-to-1. So again, about 70% of our income is going to be sheltered by depreciation pass-through in our programs on average. And I will maybe just touch on kind of the current legislative environment. So this tax code has been around for 100 years. Currently, there's no caps on eligibility, so you can do as much as you'd like in a 1031 exchange. There's no caps on it. The Biden administration has proposed a $1 million cap per year per couple in 1031 eligibility. So they proposed that in writing back in May in something called the Green Book that outlined kind of their plans and their budget proposals. Right now, what's happening is there's a tremendous amount of lobbying and education going on by real estate firms, brokerage firms, legal firms, attorney firms, construction companies, to try to educate Congress people on how beneficial the 1031 exchange tax code is to the economy. And it's estimated to contribute $65 billion a year to GDP through all the related businesses that happen when someone does a 1031 exchange. So Right now, that is being debated. We think we'll know by the end of September if there is going to be a proposed cap on eligibility. Our people that are kind of involved the closest in the process in lobbying are now kind of estimating that it's 60% likely that the 1031 won't be changed at all. So they won't put any caps on it and it'll just kind of stay like it is. And it's 40% likely that they'll put some sort of cap on eligibility, but probably not $1 million per couple, maybe a higher kind of threshold. That $1 million per couple level, that affects a lot of average, Americans. So people that own a property or two and they're selling them, you can get to that level pretty quick. So that's what's happening right now. We do think we'll know by the end of September if they are going to try to impose any maximum limitations on it per year. That would not go into effect though until January also. So what's happening this year is a lot of people that were thinking about selling a property now are going ahead and doing it and doing the 1031 because they're afraid there might be a limitation placed on eligibility starting in January. So there are quite a few transactions kind of happening now that are occurring because people are a little anxious that maybe they won't be able to do the full amount in a 1031 next year. So it is kind of creating demand in the real estate industry in general for 1031 exchanges. So with that, so I see this question, Deanna, that David asked.
Yeah.
Do you want me to read that off? And
yeah, I think that's great. That'd be great.
Okay, so David, thanks for the question. The question is, I own a duplex in Atlanta. I own land in Helen, Georgia. How do I 1031 in Atlanta to develop Helen? So what you would need to do is if you're selling your property, and as long as you don't live in it in Atlanta, so as long as it's not your primary residence, you can sell that and then you could purchase additional property in Helen. If you already own the land in Helen, you couldn't take the proceeds and then use that to develop a property on the land that you already purchased. But you could use the proceeds from the sale of your duplex virtually to buy anything in real estate other than a house that you're going to live in. So the 1031 tax code, the only restriction on it really in type of real estate is you can't live in the house that you're doing the 1031 in, either selling or buying. So any other questions or any thing, Deanna, that you would like for me to touch on? And I will say this is just a real small part of what Deanna and her firm offer as a practice. So we definitely appreciate the partnership with Deanna's firm.
Joe, we did have another question. If you inherit a home, can you do a 1031 exchange on it and then avoid the inheritance tax?
So if you, let's say your parents or someone passes away and leaves you a house, as long as you don't live in that house, let's say you turn it into a rental, and then you hold it for 2 years and then you sell it, then you can do a 1031 exchange. But in general, if you live in it, it doesn't qualify. And then you do get a cost basis step up at the time of death when you inherit property. So basically the value you receive the property at is your new cost basis. And then the appreciation in the value from then on, if you sell it, becomes taxable unless you do a 1031 exchange. So to answer your question, Michelle, you would need to not live in that property, kind of use it as a rental, and then look to sell it. It's recommended that you own property for 2 years before you sell it and do a 1031 exchange.
Yeah, but so it sounds like, and from my end, I know she wouldn't even at the current stage of tax law, If she didn't want, she wouldn't need to do a 1031 exchange. You would just get a step up in basis. So you inherited the property at, let's say, 300,000 at the date of death, then that's what the basis will step up to. So if you sold it immediately, not having that tax. We did have another question. Can I sell it to an LLC and buy it from the LLC?
So there's various ways to kind of do this if the property's owned in an LLC. So an LLC can own property and then sell it and do a 1031 exchange. So one of the conditions on a 1031 is when you purchase a property, it has to be purchased by the same entity that sold it. So the legal registration has to be the same. There are ways to work around that. There's a strategy called a drop and swap, which is basically if it's a multi-person LLC, some people remove themselves from the LLC, and then the LLC sells the property, and the remaining members of the LLC do a 1031 exchange. So there's various ways to kind of work within the structure of an LLC. So glad to cover that, David, in more detail with you. And I could also engage a qualified intermediary to kind of join in on the conversation to make sure that you structure it kind of properly on the front end and follow all the little nuances that are involved with an LLC.
Perfect. Well, Joe, this was great. I just think this is such a creative way of thinking outside of the box with this strategy, and just to kind of recap it and just small steps, we can, with this strategy, defer huge capital gains tax potential while earning an annual income, just like you would with, let's say, a rental property, but in a more tax efficient manner of earning that income and not having any of the expenses that we would need to maintain, let's say, the rental properties. And then at the end, when Inland sells the property in the DST, then we kind of get to start over and say, all right, do we want to pay taxes again? We get to make the same decision. Do we want to defer the taxes, or do we want to find another vehicle? So, and getting the end return from the appreciation of the property as well. So I just think this is just great to even know about the existence of 1031 exchanges. For example, this happened right in my back door. One of my best friend's parents had owned a condo in Clearwater, Florida, that they had purchased over 30 years ago. So you can imagine the appreciation over 30 years that this condo had. And they ended up recently selling it for about an $800,000 gain. And they had to pay over $250,000 of that to the IRS. You know, just a few months later after that, they ended up buying a lake house. And if they would have told me, then I would have suggested doing the 1031, and they could have deferred that entire tax bill. So, you know, even just to be educated on, you know, how you can use this to buy another property. You just need to be sure, Joe, like you said, you got to follow the steps to the T. You've got to get that qualified intermediary involved before the sale. You know, it's just also great to know we have that option to go into another property or into an investment option like what you've explained today. You know, when we're just done owning second homes or done being the landlord and fixing something every other month, we're just looking for that same income though that we were used to getting. So if you are a realtor or an accountant, you know, your clients are looking to you to at least understand this as an option as well. And I know that this can be very confusing. So sometimes it's better to have a quote run with your exact situation. So you can compare maybe what you're used to getting from your rental income to the return that you could make each year with inland, and also see the tax savings on paper in that quote that I know Joe and I can be able to provide. And that could just help spur your own specific questions for your situation. So with that being said, you can visit our website, timewise.financial.llc.com. And you can set up, we have a Calendly appointments, 15-minute get to know you call, and we can run that quote for you, or you can just set up some time if you have any questions that have come up from our webinar today. So Joe, again, I just want to thank you for this invaluable information and the time that you've shared with us. And I hope that everyone's learned something new today. So hope everyone has a wonderful day. Joe, thanks again so much.
Oh, sure. Thanks, Deanna. Always a pleasure working with you, and hope everyone enjoys a nice short week here this week and has a great weekend.
Yes, thanks so much. Okay.
Thanks
Bye-bye.
again.